sitting outside the market.
Yeah. It's kind of heartbreaking, but people don't know, they don't understand it, and when they don't understand, they're afraid to do anything.
Yes.
You know, the inclination is to do nothing, and so we prefer to do nothing when they're invested. So okay. So let's get back then. Why should I have a risk-managed portfolio? And now we're going to start getting into some of the slides that you've prepared for
Yeah,
us.
if we could take a look at the first slide. This is a slide which demonstrates the returns of a portfolio over the past 37 years. This is a risk-managed portfolio. On the slide, it's called FWCG, happens to be the name of our company. And it's compared to a non-risk managed index called the S&P 500. The two top rows are the ones that I want to focus on, the returns and standard deviation. The standard deviation is a measurement of risk. So what it says is that the risk-managed portfolio, the FWCG portfolio, earned 10.3% per year after fees and expenses, but had a risk or volatility of returns of 15.26%, in contrast to the S&P 500, which represents the stock market. Remember, I said it earns close to 10% over your lifetime. In the past 37 years, it's earned 9.5% per year with an 18+% measurement of risk. Mm-hmm. So at the bottom row is the growth of $1. It says that those two portfolios, the risk-managed portfolio would have earned $37.70 for every dollar that you had invested, while the non-risk managed benchmark would have earned just slightly more than $28. Mm-hmm. That is a critical slide because it's what I'm going to say is that the stock market earns 10% per year over the longest period of time. It might be 9.5, it might be 10.5, it certainly won't be 10.00, but the key is that that stock market cannot persist and earn only 2%, and we've never had the market produce 20% over extended periods of time. Mm-hmm. So 10% is what it's been producing, and it is our belief that that market will continue to produce that 10% over the longest period of time.
Right. Now, when we talk about this 10%, obviously it's not just clocking off 10% like a bank account does. That's why we've got that standard deviation. There is increases and falls, and so some years it's actually going to fall back a little bit.
Yes.
And then you're going to see an advance. But an average over time is where we get this 10% number from.
Yes.
But the critical thing again is that you look at the overall, you're getting this payback for taking that risk, I guess is the bottom line.
Great. Okay. So you can't expect to beat inflation after expenses and taxes and not suffer some risk.
Yes.
And that's the amount of risk that you suffer in the stock market. The risk-managed portfolio gets the same returns with less risk.
Right.
Okay? Slightly more on that chart, but if we'd done a different time frame, reported a different time frame, the difference between the returns of the S&P and the risk-managed portfolio vary over time. Mm-hmm. And I'll just agree that they're equal.
About the same.
They're real close to the same. Yeah. You hold our risk-managed portfolio for the rest of your life, you're going to get the same returns as the S&P 500 with less volatility than the S&P.
Right, and that's a critical thing as well, see.
Yeah.
So let's move on then
look at
to our second slide two.
Slide number 2 is a mountain chart, and what it shows is that there is, if you put $1 million, that's your retirement portfolio for the viewers.
Right.
This is your retirement portfolio, and at the top of the chart, we're going to show the orange line is banks, bonds, and bills. Mm-hmm. And what it says is that for every $1 million we put into banks, bonds, or bills, we got $8.40 of return. And for every $1 million we put into the S&P, it totaled to be $28.70. As we saw on the previous page, the investment in the risk-managed portfolio produced $37.70 for every dollar that was invested in it. Okay. It's over a 37-year time frame.
Right.
The bottom chart is the key to determining the advantage of a risk-managed portfolio during retirement. Because during retirement, we're spending down. And earlier we talked about what is the number. What number can you withdraw from your portfolio and expect that portfolio to maintain in value or grow in value such that you never outlive your income. We have chosen a number of 5%, and I'll demonstrate why in this chart. If you take 5% out of the gold line, which is the banks, bonds, and bills, banks, bonds, and bills did not produce 5% from 1972 through 1993. So you outlived your principal.
Yeah.
That's why you don't put your money into banks, bonds, or bills. It's a graphic representation of it.
Right. So basically what it shows on the chart is that your funds are petering out, and if you'd started, again, back in 1972, drawing from this fund, within about 20 years, it would be all gone.
All gone.
Yeah.
You'd be calling up your kids saying, "Do you have an extra room?"
Right. And the life expectancy from a person, I got a couple at 65 these days, I guess it's supposed to be about 30 years?
Close to 30 years.
Yeah.
Yes. One of them's going to be alive at age 90 plus.
Yes. Okay.
Okay? So the bottom chart shows that if you pull 5% out of banks, bonds, and bills, it won't last 20 years. Surprisingly enough, the S&P earned 10%. We saw that on the previous chart. But it can't sustain a 5% payout. And the reason, it's got too much volatility. It goes down too far and can't pay out 5% of principal and expect market movement to earn back that lost principal.
So when you draw out in a down year, then it just can't recover.
Market's not strong enough to recover that lost principal.
Okay.
That's because the S&P goes down so far. It's got it's a lot of volatility. In contrast to the risk managed portfolio, which gets very similar returns to 10% per year, and can grow to be worth $9 for every dollar. $7 for every dollar you started with, and pay out 5%. That's key.
Yeah.
Okay.
Okay. So then really we're getting into our last question that covers a lot of slides. So, and that is just, why does a risk managed portfolio produce up to 50% more retirement income to me? This is really significant, folks. So, listen very carefully to what we're talking about here. We got about 5 minutes, as you can see, Craig. So do your best here in the little time that we have left.
Turn on. Okay, for slide 3, if I'm going to redraw that risk return, I'm going to make a chart where the returns are on the y-axis and the risk is on the x-axis. And then I'm going to plot the S&P on the far right, showing that it has on the 10% return line, but has 18% volatility. In contrast to the risk managed portfolio, the blue line, which is a little to the left, less risk, same return, but 15% volatility.
Yes.
On that chart, I've also plotted what a CD. Let's pretend that I could find, just pretend, that I could find a CD that pays 10% per year for the rest of your life. What a find.
Yes.
How much income could you, it would plot on that chart where I've pointed it right on the 10% axis on the Y line, but by definition it has zero risk.
Yes.
Zero risk, because it pays a level 10% every year.
Yes.
So how much income could you spend out of that and know that you would not outlive your income?
So not counting inflation, you could spend the 10%.
Yeah.
Yeah.
You'd get, if you put $1 million in there, you could spend 10% or $100,000 every year. Inflation would tend to reduce your buying power over your life expectancy. Okay? Slide 4 demonstrates the amount of income that we can get out of those 3 portfolios. Remember, the S&P could not pay the S&P could not last more than 23 years paying out 5%. It will grow in principal if you only withdraw 4%. In contrast to our risk-managed portfolio, which grew to be worth $7 and paid out 5%, it can sustain a 6% payout and still have growing principal. So the difference between what the S&P pays out at 4% and what our risk-managed pays out at 6% is a 50% growth in income.
Okay.
That's significant.
It is significant.
to demonstrate how effective zero risk is, I plotted the 10% income, 10% payout of the CD on this chart as income during your retirement years. So we know that the CD earns 10%, it can pay out 10%. That's 100% of earnings. The only difference between the CD paying 10% per year and the risk managed portfolio paying 10% per year and the S&P 500 earning 10% per year is the amount of risk. In other words,
Yes.
the lower the risk, the higher the payout.
Okay.
Our clients are getting significantly greater income from their risk managed portfolio during the retirement years than people who do not have a risk managed portfolio.
Right.
That is how critical using a risk managed portfolio is.
Yeah.
So let's look at the last slide.
This is slide 5, please. It's the one on bonds.
And
So,
this chart demonstrates how I built the risk managed portfolio. It's called Mod 50 on this page. I added 30% bonds to 100% stock portfolio. That 30% bonds produced a portfolio that we've seen the risk reward performance on.
Okay.
Plotted it right there on this chart. The problem with adding more bonds is that soon I would have 100% bonds in my portfolio
Right.
and achieve the risk reward ratio of bonds, which we say is unacceptable.
Right.
So adding bonds only works for a small, it only works up to about 30% of your total portfolio.
Okay.
As you approach 40% or more, you're going to get less return, therefore, and less risk.
Right.
You need to balance your portfolio to maximize the risk-reward ratio so that you can maximize the income payout. How much can you pay out of a risk-managed portfolio? Well, it's probably, if you've got an effectively built risk-managed portfolio, it'll start at 6%. If you don't have a risk-managed portfolio, it could be at or below 4% per year.
Right. Okay.
So building a risk-managed portfolio is key to maximizing your income potential during retirement.
Yes. Okay. Well, we have about a minute left.
Good.
So maybe what I'll let you do is maybe if you have a final thought that you'd like to put out.
Sure. Hiring a fee-only advisor means we don't receive commissions on the sale of a security. So we're not tempted to sell you something to change your portfolio all the time. The portfolio that we have demonstrated to you, this risk-managed portfolio, we've had with our clients the same portfolio, the same allocation since 1990. We've got 20 years track record. Every one of our clients held on to that portfolio during the Great Recession. So everybody has recovered from that recession. And our portfolios have earned basically the same returns as the stock market, but with less risk. Therefore, they've got higher payout during retirement.
Okay, Craig, we're going to have to wind it up here. So thank you very much for being
Critical.
my guest. I'm looking forward to having you back, I hope another time.
Thank you, Mike.
Folks, actually, this is one of the most important messages that we have for you in my whole series, I think, and that is how can I make my assets last? How can I have a 50% increase in the amount that I can take from my funds during my retirement?
Yeah.
This is a big deal. So think about this carefully. You're not going to hear this message from your stockbroker. And I hope to see you next time on Financial Insider Weekly.